Hello and welcome to SimplerOptions.com. My name is Don Kaufman. I am filling in for John Carter a couple of times this week, and it couldn't have been a better week. I'm all about volatility, and that's exactly what we are planning to get, ladies and gentlemen. Here we sit on a Sunday afternoon. I am on Pacific time. The S&P futures have been open now for 34 minutes, and they're down 30 handles on the news out of Greece. Chaos in Greece over there. Looks like it's going to be a no vote. Nevertheless, one thing I'm going to be looking for throughout the course of this week, crazy as it may sound, with the SPX at 2076. The SPX at 2076. I'm going to look for the S&Ps to touch down all the way near the 2000 level in the next 5 days. Again, to touch, not necessarily close down there, but touch down to the 2000 level. You got to think about major areas, in big round numbers. The 2050 level actually had some fairly significant support when we touched down there last week. Here's the S&P futures already down at 2039. They traded right through the 2050 level like butter. So I'm going to be looking for S&Ps to be all the way down near the 2000 level. And as such, there's a couple of different ways you can trade this. Now, one of the things that you're up against is here we are on a Sunday night. Tomorrow morning when the S&P reopens, okay, listen, it can be probably in the neighborhood of down about 15 to 30 points. Listen, the S&P futures are down 30 right now. It doesn't mean, though, in the middle of the night we can't bounce a little bit. You never know. We're very headline driven right now. Doesn't feel like it's going to bounce, but I would expect us to be near the 2000 level in the S&Ps at some point this week. As such, I'm looking to place a little bit of a funky trade for me. I'm going to look for what's actually termed, it's a version of an iron condor. It's actually called the iron butterfly. Okay, yeah, I like the band. All right, so what is the iron butterfly? Let's go over to the Analyze tab. I actually brought it up over here. You don't have to be an Analyze tab geek for this stuff. All I'm doing is I'm selling the 2000 calls, and I'm using the shortest duration possible. Okay, I'm using the July 2s. This is a 5-day trade. Okay, risk is everywhere right now. All we're doing is just taking a very soft bet that at some point during the week we actually touch down to 2000. Again, 2000. That's 76 points away from where we currently are. So this trade is not per se a high probability trade, but it also is not going to have an extraordinary amount of risk. What I'm doing, so I'm selling the 2000 calls and I'm selling the 2000 puts. So I'm selling a straddle. But to sell a straddle naked when the S&Ps are going to be down like 30 tomorrow, that would not be a bright move. So, on the outskirts, what I'm actually doing is selling the 2000 calls, selling the 2000 puts. Then I'm turning around and buying the 2030 calls as a hedge, and I'm buying the 1970 puts as a hedge. So it's a $30 wide call spread and a $30 wide put spread. The entire credit for the trade happens to be none other than $27.80. Realistically, tomorrow, markets are going to open down big. You'd be lucky to get a fill about $25. Okay, so if you got a fill at about $25, and that, again, that would be realistic with this kind of a down move. So if you could get a not a $5 but a $25 credit on this particular trade, you've got yourself how much risk. Okay, and that's what you want to look at in a trade like this, because it's not an extraordinarily high probability. Okay, but ultimately what you're going to be looking at is risking $500 in the trade. Max profit $2,500 is a pipe dream. It's a pipe dream. You're not going to make the full $2,500, but you might be able to capture about $1,000 if we come down to that 2000 level. Okay, and maybe a little bit better if we even pause at 2000 for a day or two. Now, for those of you that want to take this trade and you want to add just a skosh more risk over there, you can actually take this put. Instead of buying the 1970s, you can back them off a little bit. Okay, leave yourself a little bit more risk to the downside. You're like, I don't like risk, then stick with the 1970s. You'll actually back off to the 1950, because the 1950s you're going to collect a little bit more credit on there, just a little bit more credit. Okay, but then you got to think, what's the probability of the market coming all the way down? okay, to that like 1950 level. And really, we'd have to be trading at 1950 or below for you to take that full hit. Is it possible? Absolutely is possible. But we got to trade all the way down through, okay, the 2000 level to get anywhere near the 1950 level. And we come down to what? We come down anywhere near the 2000 level. Every day that passes is going to be a day of decay in our favor. And I'm actually going to just, push the date forward over here. A decay in our favor is a good day. And ultimately, this trade is likely to mature faster than the market. It could even move down to the 1950 strike, so you can add a little bit of extra premium by kind of breaking that lower wing all the way down to 1950. Again, the standard, you'd be selling the 2000 calls, selling the 2000 puts, buying the 2030 calls, buying the 1970 puts. The non-standard, adding a little bit more risk, could just be buying the 1950 puts. Once again, this is in the shortest duration possible. It's using the July 2s over here. Good luck to you guys this week. It's going to be a volatile one out there. No doubt, one thing to really keep in mind throughout this week, in the midst of some of the most wild down moves that I've ever seen, it's the up days that can really rip your head off. Okay? Be very careful when the market does rally. And it likely will at some point this week. If the S&Ps get crushed tomorrow, we'll have a bounce day, maybe Wednesday. Who knows? Okay, don't know what this week looks like. It's a very media, frenzied week out there. You have FOMC minutes coming out on Wednesday. But if the markets are going to bounce, be careful. Volatility is elevated. Don't get caught in a vol crush. That simply means don't buy calls just because you think we're going to go up, because we are going to go up at some point. And when we do go up, the first thing that's going to get hit is volatility. And volatility is going to get sucked out. That sucks the premium right off the bone of these options over there. And what's really going to suck is, in the end, your position if you bought calls looking for the rally over there. You got to get a little bit more cute around volatility, sell some premium when you can. Thanks a lot, everybody. I'll be back on here at simpleroptions.com. It's Don Kaufman throughout the course of this week. Have a good trading week. Bye-bye.